because we believe the prospects for that business. We believe the analysts who are covering Infomedia, we believe the analysts who are covering that stock, which is where the valuation comes from. It comes from analyst forecasts. We think they don't understand the business properly. They don't understand how big this business can be. So we think they're being undeservedly conservative. And you'll notice that they've continually upgraded. If you read the analyst research that comes out, they're always upgrading their numbers for this company, aside from the recent results where they lost a contract with Jaguar, which, by the way, we think they'll replace. So we bought more of the stock. We think those analysts are constantly catching up to the company. Now, we've managed to talk to the head of distribution, or the BDM in the United States, who's hiring and recruiting staff to sell this product across dealerships in the United States. If they get a dealer in Australia, a big dealer, Toyota in Parramatta, for example, a Toyota dealership in Parramatta might have 10 hoists in their service centre. Hoists are those hydraulic machines that lift the cars up that the mechanics then work on the car. They might have 10. And if they've got 10, they might buy four modules from Infomedia for that service centre. In the United States, where they've only just started rolling the product out, they're only just starting to do it. A big Toyota dealership in Los Angeles, for example, in Hawthorne or Pasadena in California, in LA, a big dealership, Toyota dealership, has 100 hoists, not 10. So we think the upside potential for the company is very, very good. But remember this, guys, it's a small company. We've got less than 2% of the portfolio in Infomedia, and we could be completely wrong. We've ignored the safety margin that comes from the analysts that are covering that stock. So if you look at the number of analysts covering the stock, so go to that. How many? 4 analysts covering the stock. One of them's probably just been sacked. Right? So only 3. Right? So we don't think there's enough coverage of that company, so we have had to do our own analysis of that. Now, there's no way that we can... See, if you said to me now, like you could turn around and you could say, well, Roger, we want your forecasts in Skaffold. The problem with that is that you would be disappointed that we're not covering all the stocks. We're not covering the ones that you own, or we're not updating it as frequently as you would like. So that would be a problem as well. So the best way for us to quantify it is to use the analyst consensus numbers and put a range in. There's a range as well. So the most bullish analyst forecast is in there and the most bearish analyst forecast is in there. There's nothing stopping you from opening an account with that broker and then talking to the analyst, and actually asking, seeing which analysts cover the stock and then talking to them about why they've come up with that forecast. Skaffold is doing an irreplaceable job for us in terms of finding the quality businesses that we should research. Skaffold showed us Infomedia. We went and talked to the company and we thought, you know what, this is even bigger than what the other analysts think. So what Peter's done is he's created portfolios within Skaffold where all the stocks are in one industry. So it might be all the healthcare stocks, or it might be all the energy stocks, or it could be all the oil producers, or whatever it is. So he's created multiple portfolios where it's given you the opportunity to sort of stand back and say, okay, well now I can get a sense of who the competition is in that industry, and that helps you to understand how they're competing against each other and who might be better. You can rank them all by, in that portfolio, you can rank them all by return on equity, for example, or debt. And you can see, that'll give you a sense. By the way, high rate of return on equity with little or no debt is a good sign, not necessarily a determinant, but a good sign that the company could have a competitive advantage. So if you do what Peter suggested, create portfolios of individual industry stocks and then rank them by return on equity and debt, then what you'll actually find is those that are competing more effectively in the industry. And that's a good place to start looking. Thanks, Peter. Well, if you're only investing in the Australian market, I think everyone should have cash. I always do, because inevitably you're going to come to a takeaway shop and they'll say, no, we don't take cards, it's cash only. So you should always have cash, right? Which my kids always say, Dad, can we buy that? No, I don't have any cash. Dad, why don't you have any cash? I don't carry cash, I just have cards. So it frustrates me. So we should always have cash. And I have personally cash in term deposits as well. But here's the interesting thing. I don't have any Australian term deposits. They're US dollar Singapore dollar and British pound term deposits, and because I think the Australian dollar is probably uncompetitively high even now. There's no right amount that I can tell you. It's different for everybody, obviously, but you should always have cash because inevitably there will be opportunities that come up, and if you don't have the cash, you won't be able to take advantage of them. We have in the past bought a company with a performance score of 4, where we've spoken to management, and we know that the business, that was a one-off. There was a borrowing of money that they needed for temporary working capital purposes. They've already paid it off, so when the result comes out, that won't be there, and we already know it'll go back to a 3. That can happen as well. Yep, you're welcome. Okay, so my next door neighbours' names are Nita and RJ, and on one side, and Rose and Bob on the other side, and I wouldn't trust them with stock picks. I trust them with gardening tips. They give me a lot of tips about my garden, but I wouldn't trust them with stock tips. We would ignore that. Just ignore it, because it's more than likely the market capitalisation is going to be too small anyway. You know what? There was a guy when I lived in a suburb called Russell Lee when I was first married. We bought a company called QBE, the insurance company. The World Towers, remember the World Trade Centre had just been hit, and the share price of QBE plunged. It went from $16 to, I think it got down to $3 or $4, and we bought stock that day that it dropped. And I remember the guy across the road, Richard, his name was, and he was the best Weber barbecue guy ever. Like, he made his chicken on the Weber was astounding. Anyway, just a side story very quickly. One of our chickens had died, and Richard across the road had cooked up a chicken and on the Weber. And my wife called me home from the office. She said, "There's a chicken dead. I'm not dealing with it. I don't want to touch it. It's very sad. The other chickens are eating it, and you need to come home and put it in the bin," which I did. That night, Richard made a chicken on the Weber and he brought it over. And I said to Kerry, my wife, wouldn't touch it. But anyway, he was in it was a funny story. He was in the insurance industry, and he came across the road one day and he said, "I saw that you'd written in the papers about QBE. I don't think you should own QBE. I think you should, and I'll tell you why." And he told me all the insights. And I thought, gee, I didn't know that about the industry. That's an interesting thought. I'll sell the stock. And I sold it at $16, and it went to $35. Don't listen to neighbours. No. So the reason we exclude materials and energy, very, very simple. If you could pull up, Shepard, if you could pull up BHP on the capital history view. Remember I said it was a really important screen, the capital history screen? So if you pull up BHP, so one of the things that you'll notice, and scroll down to the data for a second. So you see the debt's rising and the equity's rising, but look at the return on equity line there. See how it's going down? So you're giving the company more money, giving it more debt, more equity, but return on equity is dropping. So if we have a look, I just need to stand back here for a sec and we'll finish up on this slide. So if you look at the normalised profit of the company back in 2006, here, you can see, so just highlight that with your arrow there, Shepard, so the people on the other side can see. So you've got $13.6 billion of profit there. Go to 2013, 2014, it's about the same, roughly. It's $1 billion more, but it's about the same. In fact, it's lower than it was. So it's lower than it was even in 2007. So there's been no growth in profits. In fact, profits from 2007 have declined. There's been little growth from 2006. But if you have a look at the equity that's been put in and left in here and here, equity put in is new capital raised by the owners. So the company has approached the owners and said, "Give us more money." And equity left in is retained profits that's been reinvested. So if you look at those two numbers, they were 4.7 and 28. You've now got 3.4, so it's a little bit less, so they've bought shares back. But $74 billion of your money, it's your money, you own the business, it's your money that's been reinvested. And if you look at the debt, right down the bottom, total debt's gone from $12 billion to $36 billion. So the company's got the benefit of a lot more debt and a lot more equity, and yet its profits haven't grown. Now, why? It's a cyclical business in a cyclical industry. Now, I've just written a blog post where the West Australian Times were talking about prices for property in Port Hedland. And houses were selling, 2-bedroom houses in Port Hedland, which weren't houses so much as a caravan without wheels, were selling for over $1 million. And the article went on to say in the WA Times, this is when the iron ore price was $180 a tonne, that the boom could last as much as 60 years. Not 60 weeks, 60 years. And what we knew is supply was coming on board and the price of iron ore would eventually drop. And I remember having this debate with the CFO of Fortescue Metals Group with Ticky Fullerton on Late Line Business, and he said the long-run average price for iron ore would be $100 a tonne. And Ticky turned to me and she said, well, what do you think about that, Roger? That's the CFO of one of our biggest iron ore miners in Australia saying that. And I said, never ask a barber whether you need a haircut. There's no way it'll be $100, and here we are at 60, in the 60s. And for 40 years or 30 years before 2004, the iron ore price traded between $10 and $20 a tonne. So we don't want to own those businesses, and the oil businesses, Woodside, exactly the same. They're constantly reinvesting. It's very expensive, and they're not passing, there's no benefit to that extra capital. They're always saying, trust us, trust us, trust us. We're going to reinvest this money in a new gas pipeline, and we're going to do this and do that, and it's going to come, and it always gets eroded.